When you first step into the world of cryptocurrencies, all of the jargon from the blockchain can be confusing. While certain blockchain-related terms may be familiar, some investing terms are difficult to comprehend. APR, APY, IL, what do these abbreviations mean? And how does everyone seem to understand these terms? In this video, we're going to break them down for you. If you like to stay updated to all things crypto, make sure you click on that subscribe button and turn on the notification. Also, follow us on Twitter, Instagram, and Facebook for all the latest crypto updates. Let's begin. APY stands for annual percentage yield, and it is a way of estimating the amount of money generated over the course of a year in lending and yield farming protocols. Some factors to consider where the compounding returns are concerned include the fees, token price, interest earning procedures, and the sorts of crypto assets offered. These can differ a lot from protocol to protocol. Simple interest is earned when the APY is the same as the interest rate paid on a person's investment. When the APY is larger than the interest rate, it means that the interest is compounded, meaning the investor is receiving interest on the interest he has accumulated. The standard way of calculating APY is with this formula, where R is the stated annual interest rate and N is the number of compounding periods each year. However, when it comes to crypto, APY is computed variably, depending on how frequently the yield is dispersed. For example, rebase tokens such as Olympus, Wonderland, and Klima allow depositors to earn rewards every epoch, usually every 8 hours. This means that your deposited tokens will effectively compound 3 times within a day, resulting in a much higher APY than if your tokens were only compounded daily. The APY might change depending on the token price and the total quantity of deposits in crypto. Some systems offer returns in the form of additional tokens, which users must manually claim, sell, and compound against their initial payment. The general rule of thumb is that the higher the number of compounding periods, the higher the APY. Sometimes, a protocol may display the APR, or annual percentage rate, instead of APY. The key difference is that APR can be regarded as simple interest, where the effects of compounding are not included. APR, or annual percentage rate, is the reward that investors may gain by making their crypto tokens available for lending, taking into account interest rates and any other costs that an investor must pay. APR, often known as simple interest, provides DeFi users with a figure that can be readily compared to other protocols' rates. Unlike APY, compounding interest is not included in the APR. Some cryptocurrency exchanges do not give you the freedom of lending out your coins. Those that do, however, offer a variety of charges. These interest rates vary greatly depending on the type of loan or currency you lend. As you may have guessed, APY and APR are nearly identical tools that provide different results. Both relate to the annual investment income. However, thanks to compounding, APY delivers a bigger return profit. Although both terms are related to the rate of return on your deposits, APR does not take compounding into account, but APY does, which is why the APY for any investment is normally considerably greater than the APR. This image here is the APR for Trader Joe's farms, which shows you both the yield for providing the liquidity and the bonus returns from staking the LP tokens in the corresponding farm. Assuming your yield is compounded every month, investors could earn interest on top of the interest earned from previous months, resulting in additional yield that can be pretty significant in the long term. Impermanent loss happens when liquidity providers receive different amounts of assets upon withdrawal compared to when they first deposited them into a liquidity pool. Wait, but why does this happen? This happens when there are changes in token price, which affects the composition of the liquidity pool, resulting in you having slightly less or more of a particular token. For example, even if you deposited your assets at a 50-50 ratio at the start, say ETH and DAI, there is no guarantee that you will receive the same amount of each asset in the end. Liquidity providers might receive a lower value of asset compared to simply holding the tokens in their wallet instead. Here's another example. Let's assume that the price of 1 ETH is equal to 1,000 USDC, and Alice wants to provide liquidity to the ETH USDC pool. She needs to deposit 1,000 USDC for every unit of ETH she plans to deposit. Alice deposits 1 ETH and 1,000 USDC into the liquidity pool, which now holds 10 ETH and 10,000 USDC in total. In other words, Alice's $2,000 deposit now makes up 10% of the pool, which has liquidity of 100,000. Now, if no one withdrew their liquidity, it should remain constant at 100,000. However, the ratio of ETH and USDC in the pool has now changed, consisting of less ETH and more USDC. At a price of 4,000 USDC, there should be 5 ETH and 20,000 USDC currently in the liquidity pool. Since Alice owns 10% of the pool, she would receive 0.5 ETH and 2,000 USDC if she chooses to withdraw her assets, which would be worth $4,000. If she had just held 1 ETH and 1,000 USDC instead, her funds would have been worth $5,000. By providing liquidity, we can see that Alice made less money than she could have made by just holding. Even though she didn't technically lose her initial capital, she experienced what we know as impermanent loss, which becomes permanent after she withdraws her tokens. This is not accounting for the swap fees she might have also received for being a liquidity provider. Investors may now put their assets to work in a variety of ways, thanks to DeFi. Rather than keeping their tokens in their wallet for the long term, they may utilize them to create revenue by providing liquidity to other platforms. More often than not, the price of the newly minted governance tokens will skyrocket, either due to excessive demand or low liquidity. In either case, the APYs for staking and providing liquidity balloon to massive proportions, which will attract even more depositors. However, as we've seen on numerous occasions, this form of liquidity mining is unsustainable and will not last for long. As such, it is essential to determine how the yields are generated and calculated. High APYs won't count for much if the protocol doesn't survive for long. We hope you found this video extremely helpful and that you now have a clear understanding of what each term means and the differences between them. If so, do hit that like button and subscribe. Do you have any other terms you can't seem to understand and would like us to make a video on? Leave them in the comments below and let's educate each other.